All right, have you ever looked at a stock chart and thought, what is even happening here? Well, today we're going past the standard technical analysis. We're getting into the raw, unfiltered psychology driving every single tick. Welcome to our explainer on the ultimate chart pattern guide. We're going to transform those seemingly chaotic zigzags into a super engaging visual story of buyers totally battling it out against sellers.
Okay, let's dive into this. It's kind of fascinating when you realize that these charts, they aren't just dry, boring math. No, they're a live, real-time reading of human emotion, market psychology in action. Every single movement, up, down, sideways, it's driven by fear, greed, or just plain indecision from literally millions of traders worldwide. So when we learn to read these patterns, we aren't just reading numbers. We're essentially reading the collective mind of the market itself. How cool is that?
So, here's our roadmap. We're going to break this huge topic down into 6 logical, totally digestible steps. First, the language of the market. Then, candlesticks as basic blocks. Continuation patterns, reversals, confirming the signal, and finally, managing risk and reward. Kicking things off with Section 1, the language of the market. So, what actually is a chart pattern? At its core, it's just an identifiable movement in price that acts as a visual representation of market psychology. It literally shows us right there on the screen whether the bulls or the bears are currently holding the reins. And what makes this so incredibly powerful is that these patterns are basically self-fulfilling prophecies. Because think about it, global investors, hedge funds, day traders, they're all looking at the exact same setups. They react with the same emotional triggers, which ironically causes the market to behave exactly like the pattern predicted it would. Moving right along to Section 2, candlesticks, the basic blocks. And this brilliantly illustrates the actual heartbeat of a trend. A bullish trend relies entirely on making new higher highs and higher lows. It's a literal stair-step up. Conversely, you've got your bearish trend creating lower highs and lower lows. Now, the absolute key takeaway here is to watch the depth of the retracements. You know those little pullbacks along the way? A really shallow pullback? That shows you the trend's underlying power is incredibly strong because buyers are just rushing right back in to scoop it up. Now, let's zoom in on a couple of specific letters in our candlestick alphabet. On one hand, we have a highly reliable pattern called the bullish engulfing. This is where a massive green candle completely swallows or engulfs the previous red candle's body. Boom. Then, contrast that with a bearish pattern known as the hanging man. You'll recognize this one by its tiny body and that really long lower wick. The psychology behind these two basic blocks couldn't be more different. In a bullish engulfing scenario, the buyers are just completely overwhelming the sellers. Tech analysts look at this and see a decisive, powerful shift in market sentiment. But then you have the hanging man, which usually pops up after an uptrend. This guy signals that buying pressure is basically running out of steam. It's a flashing warning sign that sellers might just be grabbing control of the rope in our whole market tug of war. Which brings us to Section 3, continuation, the market pauses. Okay, so there are a ton of patterns out there. To help organize this sheer volume in our heads, it helps to just divide them into 2 clear buckets. On one side, we have the pauses. These are your continuation patterns, things like triangles, rectangles, and the cup and handle. And on the flip side, we have the U-turns, or reversal patterns. That's your head and shoulders, double tops, double bottoms, and wedges. Let's actually look a bit closer at one of those classic continuation patterns, the cup and handle, which basically stems from a rounding bottom. As that bowl shape completes, a trading range develops on the right side. That's your handle. Now, what analysts note here is that the ideal handle depth is a shallow retracement, usually less than 1/3 of the cup's depth. That shallow pullback is exactly what you want to see. It signals a very, very strong setup right before a potential bullish breakout. Next up is Section 4, reversals, the market U-turns. Now, what's really interesting about this slide is the angle of that confirmation line in the famous head and shoulders pattern. Notice how the neckline connecting the lows is sloping downward? That's critical. Analysts consider a downward sloping neckline break to be an incredibly strong signal for a bearish U-turn. It basically screams major weakness in the asset's price. Breaking down the specific anatomy of this beast, you're always looking for 3 parts. A left peak, which is the shoulder, a higher middle peak, which forms the head, and a lower right peak, the second shoulder. The line connecting those bottoms, that's your neckline. This whole setup is known as a distribution pattern, and it repeatedly forms at market tops. Visually, it's telling us that a stock is actively transitioning from being eagerly bought to being eagerly sold. But hey, remember, market patterns can totally flip. This right here is the inverse head and shoulders. It contains the exact same structure but turned completely upside down at the bottom of a downtrend. So instead of a distribution pattern, this is an accumulation pattern. The market is being actively bought up, signaling that a powerful bullish U-turn is likely underway. Moving on to the grammar of our chart language, Section 5, confirming the signal. Because a pattern is basically useless without proper confirmation, traders rely on technical momentum tools to filter out all the noise and false signals. For example, the RSI, or Relative Strength Index, helps traders spot if a stock is overbought when it pushes above that 70 line, or oversold when it dips below 30. Alongside it, you've got the MACD tracking moving averages. When those lines cross over each other, it helps confirm the momentum shift we're actually seeing in the chart pattern itself. Let's move to and see how this builds into an advanced market structure concept. Step 1. Price is happily making higher highs and higher lows. Everything looks great, super bullish. Step 2. Suddenly, the price closes below that last external swing low. Wait, what? Step 3. We now have what's called a bearish change of character, or CHOCH for short. This structural break confirms that the market is actively flipping its character from a bull right to a bear.
And finally, our ultimate lesson, Section 6, managing risk and reward. All these patterns, they are really just tools to manage risk in a completely chaotic environment. A reliable pattern beautifully structures a trade for you. It dictates exactly where the ideal entry zone is, where your profit target is, and crucially, absolutely crucially, where the stop loss should be placed if the pattern just straight up fails. These structures give traders a clear, objective framework so they aren't just out there guessing when to buy or sell. And that framework allows for this magic critical number, 3-to-1. This is the reward to risk ratio. Professional analysts look for setups where the expected reward, the target, is at least 3 times greater than the risk, which is the distance to your stop loss. To put that into perspective, taking trades with this 3-to-1 ratio is precisely how market veterans protect their capital over the long run, even if some of their patterns fail. It's the ultimate safety net.
So the crucial point is captured perfectly in this quote. The name of the game in trading is getting risk as low as possible. Chart patterns are the mechanism to achieve exactly that. By understanding this visual language, you're empowered to look at market charts not as chaotic lines, but as highly readable stories of human emotion. So I'll leave you with this. The next time you open up a stock chart, will you just see math and random zigzags, or will you see the invisible footprints of human psychology playing out right in front of you?